Hello friends, this is Anshul Jain from Lakshmishree. Today I'll be talking about VIX, India VIX. VIX is also known as Volatility Index, is an index which uses to measure the near-term volatility expectations of the market. Of late, the market participants have been using the word VIX very loosely without understanding what actually it is. So in this video, I'll explain you what it is and how to use it. Now, difference between volatility index and market index. While market index, Nifty or Bank Nifty, measures the direction of the market and calculated by the price movement of the underlying stocks like Nifty 50 or Sensex 30. Volatility index measures the volatility of the market and is calculated using the order book of the underlying index options. So, VIX is calculated using the order book of out the money options and the order book. Another difference is that the market index value is a number, whereas the volatility index is an annualized percentage. The volatility index is based on the order books of Nifty options, is known as India VIX. Now, how this VIX is useful to us? In India, NSE computes the VIX value. It is based on out the money options prices of the Nifty. Therefore, the value of the VIX can never be below 0 or more than 100. India VIX has a mean of 26.5 and a median of 23.8. Now, these statistics are important for option writers and traders because VIX has a tendency to revert back to the mean. So for now it is around 60 and its mean is 26.65. So we expect the volatility to drop a little bit more from here. Volatility is much easier to predict than the prices are. If we take any organization, suppose Infosys, into consideration, then the trader, he will never know what the price movement will be after the results are announced in the closed markets. But here you can easily know the volatility that may increase immediately after profit and guidance numbers are announced. For example, if India VIX is 16.8, this represents an expected annual change of 16.8% in Nifty over a period of 1 year. That is, you expect the value of Nifty to be in the range of plus 16 and minus 16% from the present current price of the Nifty over a period of 1 year. So if Nifty is represented at 6,000, the expected range of Nifty for 1 year is between 5,000 and 7,000, which is 16% approx from 6,000 on the upside and the downside. If you want to know what is the expected volatility for the next month, because there are monthly options expiry in index, you also have weekly options expiry. So if I want to know the monthly expected volatility in the index, then suppose we take the current volatility index is around something 55 or 60. So if we take the value 60, you should divide it by 60. You should divide 60 by the square root of 12. So you get expected annual volatility of the index for the next 1 month, which is 17.32. 60 the percentage of index divided by square root of 12, because there are 12 months in a year. So for next 1 month, the expected volatility is between 17.32% on the upside or on the downside. So if you, as calculating this, you got a range. So if you have the range, you can easily predict, like here you have 5,000 and 7,000 when Nifty is around 6,000. So that is for yearly. If you come down to monthly, it will be somewhere around 3.5%. So you can sell out the money calls and puts over anything above 3.5. And if you sell nearly 5%, which will be a very safer bet. So this way you can calculate the monthly expected volatility and you can sell your options accordingly. The chances of losses will be very less, because if you consider those strikes that fall out of this 17% range, then the high probability of them becoming zero. So it is very important for options traders to take into consideration the expected volatility for yearly as well as monthly. For stocks, India VIX calculate the index volatility, and for stocks it is implied volatility, which is calculated and which represents the individual stocks movement over a period of 1 year. And if you divide that by square root of 12, you'll get the monthly volatility of the particular share, what is it expected. So I hope with this video you are clear how to use volatility index and what it is. So now you can trade option selling very easily using implied volatility. This is Anshul Jain signing off for the day. Thank you. For daily such content, please like and share our video and subscribe to our YouTube channel. Press the bell icon.